Well, good evening, everybody. My Facebook Live is returning because it's tax time and I love tax time. Thank you for joining me on this live. It's fantastic to return to being with you live. It's been quite a while. We've had a busy time and lots going on, but I'm committing to coming back to be live with you all on Wednesday evenings once more. And tonight, we are talking tax time. If you haven't seen it already, we have an article up in the Brilliant magazine, and the lovely Meredith helped me take my ideas and put them into a much more palatable way of talking about tax. So we are going to be talking tonight around that whole article, and if you would like some more detail on any particular area, then I encourage you to send me some questions for future Facebook Lives that I will be doing. Now, bear with me while I see if I can find out who's in my audience, if I have an audience. Oops. Oh, well, there we are. We have 5 people. I'm very excited to see you all. I'm sorry as I fiddle with things to check what's happening. I can't tell who's here, so by all means, if you'd like to say hello and pop something in the chat, or ask questions by commenting, I would love to hear from you. In the meantime, I will stay with my script and just keep an eye out for whether anything's popping up. So thank you for joining me. As I said, we've got a brilliant article out at the moment, which is 10 things to minimize the tax time drama. Meredith helped me with this, and I'm going to speak directly to the article and see how you can all interact with that. I've got some comments. Thank you, ladies. Hello, Ellie. Hello, Bliss. And hello, Lynn. Without repeating myself too many times, I'll get on and start talking about tax. Now, the number one thing that we talked about in this article is that there is no tax time. And the reason I'm saying that is because it's always tax time. As business owners, we should have tax in the front of our mind all the time, because all of our decisions should be made with tax as part of the context. I mean, after all, under Part 4A of the Tax Act, we're not allowed to do anything only for tax planning, but we are allowed to take into account the tax system when we're making decisions about the timing of transactions and about the entities that we put transactions in, and many, many other things. So tax is something I would like business owners to have top of mind, right along there with numbers. I'd like you all to also have your numbers top of mind and accessible to you at every point in your business, so that you can utilize them in collaboration with experts to make constantly good decisions that improve your business and improve your life. I have Jane and Dennis, also known as Bo Ying Ying, online with us as well. Welcome. They are part of my team, and it's really great to have them here. The second part that we talk about in our article in Brilliant magazine this time is that the tax is not the same as your car rego. It's not just a bill due every year. And again, thanks to Meredith for helping me see these other ways of viewing things. Having worked in tax all my working life, I've always known that it's not just a bill that you have no control over. In fact, you've got quite a lot of control over the timing of your tax, and whether or not you have to pay the full installment that's being billed to you, and whether or not you could pay less tax this year and more tax next year. So it's really a headspace shift that I want you all to have, along with tax being something that we think of all the time. Now, the other thing that people get confused about is tax evasion versus tax avoidance. Now, evasion is illegal. Evasion is not paying your tax, hiding income, not telling the ATO the whole truth, doing illegal things. But tax avoidance is about managing tax, or as Kerry Packer would put it, minimising tax. It's completely legal and completely appropriate to minimise your tax. Hey Matthew, good to see you here. So tax avoidance doesn't make you a bad person. It makes you a practical business owner who is aware of the tax system, aware enough to check in with your experts to get clarity around the opportunities in different timing, etc., of your transactions. We also talked, number 5 in our article, about, do you want more out of that end of year thing? Well, maybe bring more to the table. So this is an area where being educated about your tax rates and where they fit and possibilities means that you can come well armed to your tax accountant at any time of the year and talk openly around minimising your tax. Now, for example, I want to share with you my tax graph, but what happens when we screen share on Facebook, FaceTime, is that it all gets a bit confusing. So I've made my own screen here. I'm going to do this little manual thing. You know, we adapt to a lot of things here at Better Business Decisions. When we're thinking about tax and bringing more to the table, I've got a great example of many of my clients where I've been able to explain specific things to them when I've taken into account timing, the entities that they have, this year, last year and next year, and family members, and how we can massage the tax that's payable. This graph is also available on the invitation to this live, but you can contact me anytime to get it or to have a chat about it. Individual taxes are here. We start at 0 if we're a low income earner, maybe a high school or a university student, something like that, not earning more than $18,000 odd. You don't have to pay any tax on that. So if you've got a family member that you could employ in your business, there's an opportunity to move some tax away from you down into the 0 component. Our taxes go right up at a personal level to 45%, and that is because this tax rate is designed to get, your high-flying CEOs, Maserati driving people, all those kind of people that are just on salary, they're not in a business. They need to pay that tax into our system because that's their disposable income. They have all of that money and can choose how to invest that. Whereas a business needs to reinvest. And so that's why companies have this slightly lower rate, this 25% rate. We want to make sure that we keep, as business owners, away from these higher rates, and that may be involving setting yourself up in a company. And that happens to be number 6 in our 10 tips about minimizing tax time drama. So the setting up of a company, often it's not for the big high flyers or anything. As I was speaking to Meredith the other day, I mentioned that actually most businesses are small companies, small business owners. I heard something on the radio yesterday that 98% of businesses in Australia are small businesses. So small, whether you're a tradie or someone like me, or starting to get bigger, selling goods and having big profits, it's never too soon to consider a company. It's even sometimes good to set the company up before you're making much profit, if there's some years where you could pay a salary to yourself and keep your tax down here and save that for later. The last area in here on my graph is superannuation. In superannuation funds, the money going into your fund from your business or from yourself is only taxed at 15%. There are some thresholds to stop us getting greedy about that, but we should think about that all our life, because the big part of our life we're retired and we're entitled to be taking from our super fund. And once we are entitled to be taking from our super fund's paying 0. So wouldn't you like to have all your investments, all your savings for retirement sitting in super, where whatever they earn, they don't pay any tax? So there's a lot of misconceptions around the tax rates that we pay, and This is why I'm encouraging business owners everywhere to really think hard about their tax and get educated. Start to get some of that financial intelligence that we talk about here. You may all know that I believe every one of us has some financial intelligence inside this brain. And no matter how scared we are, how much we fear numbers and all things accountants, you know, the stuffy shirts, all of that stuff, we're not all boring and we're not all condescending. It's important for you to be game enough to start learning about your numbers and grow this financial intelligence part of your brain. That's what we do here. We keep growing it with you so you can make better decisions in your business. But I better get back to the topic. So our 10 tips, number 6 was sole trader. The time to be a company might be now. We're getting a bit close to end of financial year, but it should never be completely dismissed. You may even need a second company for something. Number 7 in our list was that the taxation system is designed to help you succeed. And that was what I was illustrating here. If we move ourselves into a company, we start to pay lower tax, and that is because that company rate recognizes that we are likely to be reinvesting in our business. Now, if we're not reinvesting in our business and we're just whipping it all out and spending it on the same sorts of things that the high income earners would be, we'll have to pay tax on that. So you can't get away with just never paying tax on it because it's in a company. You will have to pay tax on it when you use it for personal use. Number 8 was that your tax plan should look very similar to your business plan. And I love the way that Meredith's put this for me, because we should be looking at a planning process in our businesses, and that process should include tax and should consider year to year. Number 9 is that superannuation should be part of your tax plan, and you've seen why. When I'm referring to this, why is because I want to think about the lifetime tax. If you're sitting at, say, 37% in your marginal tax rate and you choose to put some more super away, then you've saved over 20% tax being saved right now, and the money's been invested in your future. So it's really important to have a look at. And lastly, there is an easy way to put all this into practice. Now, Ellie Hurley is asking, do I have an example of what a tax plan could look like? Ellie, it's actually not something that we necessarily put down on paper. It's a bit of a warm and fuzzy tax plan, to be honest, because what you'll find is that tax agents will shy away from written tax advice and written examples. We're all a bit scared of the parts of the Tax Act that penalise tax agents and others from promoting schemes that are about actually tax avoidance. Now, we said earlier, I've got to get this right. Even I get these two mixed up. Tax evasion is illegal. So it's difficult to put things in writing where they may not be correctly interpreted and they may be accused of tax evasion. Tax avoidance is what we are working on and is what a general tax plan is about. And I guess they're a little subjective. We don't tend to spreadsheet them out in the way that we do our business plans. We have a top of mind idea around what years we are going to be working hard, what years we need income, what years we are heading towards retirement, and so on. But it's a really great question, Ellie. I should probably design something that's more like a mind map of a tax plan. I will take that on board. All right. So I can see our comments. Do we have any more questions tonight? Ellie's was a great one, asking about how we actually do that. Have a plan. You know what they say, when you really love something, you can talk about it underwater forever and ever and ever. And tax planning is something that I hadn't realised was quite the superpower But what's happening is that tax agents are so busy sorting the garbage that's coming from all of our artificial intelligence in our accounting packages and so on, that they don't often have time for tax planning, and that's why I want you to keep it front of mind. Ellie Hurley, retirement is also a sort of fluffy word. There is an age point in Centrelink when you can get age pension, but under superannuation there are other rules about what is known as I'm forgetting these special words because I used to work in them all the time. But basically there are different points at which you satisfy a condition to withdraw your superannuation. So retirement is a flexible word, and that's about lifestyle, but eligibility for aged pension with Centrelink is one threshold, and that depends on what year you were born in. And eligibility for taking your super out also is something that is dependent on various other categories, and you can see that the Money Smart website is a good place to look at to find out any of those things, or ask me a question via email or Facebook Messenger. So everybody, it's been so good to have you all here. This obviously works better to commit myself to Facebook Live and put it out there that we have the Facebook Live coming up. So I hope you'll all join me again next week, where I will dig deeper into some of these topics, and I'll particularly follow questions that you might have to me in the meantime. So we're talking about this article. There's a link in the event that I put up. If you'd like to have a quick read of it, it's very light, but it may trigger you to ask deeper questions. And you are welcome to, obviously not in public, you don't want to put out there what income levels you have, but in the privacy of a free chat. We do free chat through our website, or we're also doing a one-off 1 hour opportunity for you to speak directly with me to do some quick tax planning. We're close to the end of the year, but it's not too late to do things like add more super or purchase assets that are immediately written off, or think about other members of the family that have done work in your business perhaps that need to be paid. Hope that helps everybody. Good night all. Hello Sharon, nice to see you here as well. Age of entitlement, Lynn. That's interesting. I think you mean there, yeah, the age of the entitlement to the age pension definitely does depend on your date of birth. So thanks everyone for joining me tonight. I have run late, I'm sorry, but it's really lovely to have had you all here, and I will see you next week. Good night.